So where we left off on our first class is we were talking about doing an EIC analysis. And there are three major parts. Is economy, 2 would be industry, and 3 would be company for C. Right? And again, the idea is that about half of a company's performance is based on external factors. And so what we're going to try and understand with the EIC analysis is what are those external factors that will affect the performance of the company. Right? So I went over this relatively quickly last time, but basically there's 2 major factors that affect the company from an economic point of view. One is we have to forecast what's going to happen to the economy. And then 2, we have to think about the relation of the company's performance to the economy. And again, there's many different sites that we can get for economic data on, in this case, the U.S. economy. The one that we're going to choose to use is the conference dashboard. So if I go to a browser and go to conferenceboard.org on their website, then Conference Board, again, is a not-for-profit. And one of the things it does, and it just published this at the end of last week, is every month it publishes a series of indicators. One of them that's closely followed is the LEI. Now, it happens to be right here on the homepage because they just published it, but over on the right where it says U.S. indicators, if you click on the U.S. indicators, you can then click on the leading economic index, the LEI for short. So here it happens to be on the homepage, but in general you can always find it over here. And when you click on this, you'll always see that their press release is over here. So in the press release, they have this chart, and this chart will be a chart in your group projects. So every group, when you do your group presentation at the end of the semester, will have this chart in your presentation. And it is a view of the current LEI and CEI. In this case, going through December 2013, you'll have yours going through February by time we get around to our group project presentations. So the idea is that, again, these are the last 2 recessions, and it's probably a little bit easier to see on this chart, but generally the LEI tends to go down, start trending downward, before recessions occur. Right? So the idea of the leading economic index, keyword is leading, is it gives us insight as to potential recessions when it starts trending down. You'll also notice that the LEI starts to trend up before the recessions completely end. Right? So again, when the LEI starts to trend up, we feel that we've reached the trough, and then we're starting to head towards economic recovery. So essentially what you can think about the LEI is that historically it's been predictive of about 2 quarters worth of economic activity. And then the red line represents the CEI. And the idea of the CEI is that it tends to start going down as the recessions occur, and it tends to start going up as recessions are ending. So it's more coincident, tends to move more with the economy. And then again, we mentioned the lagging index. But the one that we're really going to care about is what's happening to the LEI and the CEI, and both of those continue to climb. That is one of the reasons why people are relatively bullish on the economic activity for the first half of the 2014 year in the U.S. Now, obviously, things can change, and if things start to change, so for example, you saw a big stock market sell-off last week. Why do you think that might have occurred? There was a China manufacturing index that was a little bit lower than expected. I think that caused some concern.
Also, the credit trust of China is much higher than their expectation.
Okay. So what happened here in the U.S. though? There were really 2 things in the U.S. that I think sparked the sell-off in the U.S., which then sparked a sell-off in the world. What happened in the U.S. markets? What caused the sell-off? Well, one of the things that's been hurting the U.S. is interest rates. Is that the Federal Reserve has been announcing that it's going to slow its tapering, and it is tapering. It's going to slow its bond buying, and that bond buying is actually slowing down. So interest rates, as a result, are rising. Right? So basically, you guys all probably understand the concept of cost of capital. What happens to the value, the present value of an asset when the discount rate rises? What happens to your present value? So your R goes up, becomes lower. Well, that's what's happening in the stock market today. So basically, costs of capital are going up because the risk-free rate, which everything is benchmarked to, is now higher than it used to be, and therefore the cash flows are worth relatively less. Right? So that's putting pressure on stock markets. Right? And in the U.S., what we use for the risk-free rate is the 10-year Treasury, and I'll just do Google Finance. If I go to Google Finance, the 10-year Treasury yield today is 2.72, 272 basis points. And about 6 months ago, it was about 172 basis points. So it's gone up about 1% over the last 6 months, and that has put pressure on stocks, right? Because basically, stocks have to do better than bonds. The rate of expectation of bonds is higher, therefore the expectation of stock is higher. All things being equal, that means cash flows are worth a little bit less. So that was one of the factors that now is starting to affect the market, and there's fear that interest rates could go even higher because, again, the Federal Reserve, which is buying approximately $80 billion a month of U.S. Treasury debt, right? So again, the biggest buyer at auction today of U.S. Treasuries is the U.S. government, right? So basically the U.S. Treasury sells the debt, the Federal Reserve buys the debt. Right? That's the 21st century version of printing money. Right? So we've just been printing money at almost $1 trillion a year. 80 billion a month times 12 months is $960 billion. So if you think of our deficit, it was about $1.5 trillion. We funded about 2/3 of our deficit with our own bond buying. Right? Now the deficit's going down, so therefore the Fed is tapering. But what it basically means is we've artificially constrained interest rates. Right? Because if the Federal Reserve hadn't been buying all of our debt, then the debt would have had to been absorbed by the rest of the world, and eventually the rest of the world would have said, I want better yields to get all of the debt that you're putting on the market, just supply and demand. So what's happening is the U.S. is essentially creating more supply of its debt by not buying its own debt back. Right? So as a result, interest rates are starting to go up because the rest of the world has to absorb our debt. And if the U.S. is paying more, everybody else has got to pay more. Because we're one of the benchmarks that all the other countries are essentially going to be based on. So that is putting pressure on the stock markets in the short run. Second pressure. Discount rates higher, therefore cash flows are not worth as much. Second pressure is there's fear that the cash flows aren't going to be as high. Translation, pressures on earnings. Right? There's been some negative earnings surprises by some very large companies recently. One of them is a company called Best Buy. Right? Their retail season for the holiday season was horrible. It was well below expectations. Right? There are a few other companies that reported very disappointing earnings. So the feeling of the market is the earnings aren't going to grow as much, therefore the cash flows aren't going to grow as much as we thought. The discount rates are higher. That's the sell-off you see in the marketplace today. Now last week there were 2 institutional notes that signaled that this was about to happen. Matter of fact, I was in my own personal portfolio. I had my finger on the sell button. I was like, I need to take a long-term view because you really shouldn't try and time the market. And I'm kicking myself because I knew it was going to happen and I should have sold last week and I didn't, and I feel very bad. But in any event, so I ended up losing whatever it was, 4% like everybody else. But back to the market, the reason why, pull up my Evernote here. One of the articles that came out last week from Goldman is basically what Goldman said is GE disappointed And Best Buy disappointed. And in particular in this article, and I can probably post it on the website, they talked about, this is the key number here, it's kind of hard to see, but the PE ratio on the S&P 500. And they said right now the S&P 500 trades at 16 times forward earnings. And the average S&P 500 PE ratio going back through the 70s on forward has been 13. Okay, so basically the average PE is 13. The market last week was trading at 16 times forward earnings, and what they were saying is that the market was kind of overvalued, right? So therefore, there really wasn't much upside, and there was probably more downside pressure, because we usually get that high, we tend to see a regression towards the mean. We tend to see the earnings tend to be a PE of 13. And so that was the point. If we have even less earnings, and we have the prices that we do, then the market is frothy. The market is too high. And that's what we're seeing right now. We're seeing an adjustment. And in order for that adjustment to continue in a positive direction again, we're either going to have to see better earnings or we're going to have to see lower discount rates. And right now, I think the market is concerned about both, so you're probably looking at a choppy stock market in the short run. Right? So that's what's kind of happening at the macro level. And again, EIC is part of what we're trying to do. We're trying to understand what's going to happen to the economy, and will that further influence things, right? So the good news right now is the economy is still expected to be strong, and so therefore we're probably not going to see the bottom drop out of the market, but we are probably going to see some pressure on the valuations of stocks, at least in the short run. So back to this in our EIC, right? So one, we know that the economy is doing relatively well and essentially growing, so that's kind of good news. And then the next question is, what is the beta? Let's see. My VMware has frozen. It's been acting up recently. So unfortunately, Bloomberg is Windows only software. And my Windows is dead on my computer. Hello, Windows. Try quitting again and see if I can restart it. Anyways, I was going to try and look up the beta of a company because that will give us. All right, good, VMware. Let's see. All right, back to Bloomberg. And of course, I killed my internet connection when I did this. All right, so let's try this again. All right, English. Again, if you haven't created your account, you will need it for your first homework assignment. All right. So which company were we doing again for the homework assignment? Dow Chemical. That's right. So why don't we do as an alternative, I don't know, they were talking about Best Buy. Let's do Best Buy. So here's Best Buy, and here is their beta, And again, we go to the beta screen. By default, Bloomberg gives us a 2-year beta. And what we want to look at is a 5-year, in this case, raw beta. So given Best Buy's raw beta of 1.147 right now for the last 5 years, what does that tell us about Best Buy's economic sensitivity? What did we say about that last week?
It goes to a different direction with the S&P 500.
Well, actually, the beta would go in the same direction. So the idea is that if the S&P 500 went up 1%, then Best Buy would tend to go up 1.15%. And the S&P 500 would go down 1%. The Best Buy would go down 1.15%.
But the S&P is increasing, right?
The S&P right now is decreasing in the last week. Last week the market was down. So therefore we would expect that Best Buy would probably go down a little faster than the market, right? But as I said, think about it on just a macro level. The assumption we're going to make, and I know it's an assumption, but the assumption we're going to make is that the S&P 500 index should perform relative to how the economy performs. And the company is looked at relative to the S&P. So the idea is if the economy is still relatively strong, then Best Buy is a company that we probably want to own. Why? What? Because it should go faster than the economy based on historical data. Now again, history doesn't always prove the future. That's one of the challenges with finance, is we spend so much time looking at historical data and we assume that will equal the future. It doesn't always work out that way. But assuming it does, then yes, Best Buy should do a little bit better in a better market. So again, if we're still bullish about economic growth, even though Best Buy right now may not be doing so well, we have to look at some of the fundamentals. At least on an economy basis, it should relatively do better. Okay? And that's really what we're just trying to understand. Slightly better than the average company, average big company. All right. So then we go to the I. Right. So in our I analysis, we want to look at the industry. And again, what we've said is that very specifically, a good industry, an attractive industry, is an industry where the industry ROIC is greater than the industry cost of capital. So an attractive industry is an industry with a positive spread. An unattractive industry is an industry with a negative spread. So this was a table out of the book, and what it shows is basically about 40 years worth of historical data, and it shows the different ROICs for different industries over that 40-year time frame. And during that time frame, the average industry earned about a 9% ROIC, but clearly some industries did better than others. All right. So during this 40-year historical time frame, the best performing industry was pharmaceuticals. Right? They had the highest average ROIC, and that's the ranges of ROIC. The second best industry over this period of time was software, although they had a much bigger range of ROICs. The worst performing industry during this period of time was airlines and electric utilities. Right? And again, this would have been the average industry over here. But that's the point. If you think about the S&P 500 and all of its sectors, market does okay, but some segments are better than others. Right? And that's what the industry part of the analysis is about. What we want to do in the I of the EIC is we want to understand, why is this industry doing better or worse than its cost of capital? And how is that going to change in 5 years? Right? Now, to help us do that, what we're going to do is we're going to do a Porter 5 forces analysis. So I'm certain in one of your classes you guys talked about Michael Porter, 5 forces. Well, that's the beauty of the internet. Look it up. All right? So he's all over the place now. But basically, this guy named Michael Porter from Harvard, and in 1984, He wrote a book called, I think Competitive Advantage was the book. But in his book, he talked about industry structure explaining economic performance of companies. And he specifically said there are 5 forces, which are represented by these 5 circles on this page, that will help us understand the structure of the industry, therefore the ability of an industry to make a level of profitability, right? And the 5 forces are, first, buyer power. So buyers are the customers. And the question is, who has the power in that relationship? Do the companies in the industry have power over the customers? Do the customers have power over the company in the industry? If the buyers have all the power, it's hard to make money. If the companies have all the power, it's much easier to make money. Okay? Second force, suppliers. Again, who has the power in the relationship? The companies in the industry or the suppliers? Third force, substitutes. Are there substitutes to what we do? And how viable are those substitutes? All right? So for example, if I were thinking about flying from DC to New York City, are there viable substitutes to flying to New York? What would they be?
Like buses.
One, you take the bus. Amtrak, you take the train. You could also drive.
Yeah.
All right? Let's say I'm going to Hong Kong. Is there a viable substitute to flying? Probably not. All right? You can't drive. Can't take the train. All right? Can't walk. All right? You could swim. Boat, that would be tough. So that's the point, is the viability of the substitutes could change based on the nature of the market, but we have to think about the substitutes. All right, and how viable, what are they, how viable are they? Next, entry barriers, threat of new entrants. Is it easy to get into this market? All right, because what we don't want to have a situation is suddenly we make money and then 10 different competitors show up doing the exact same thing. So if it's hard to get into the industry, then it's easier to make money. All right, think about mobile phones. What are the barriers to getting into the mobile phone market? Think Verizon, AT&T, Sprint, T-Mobile in the U.S.
The infrastructure.
One is the infrastructure cost is extremely high. Like just having a tower, getting all the rights for towers is extremely difficult. In some cities, the cities won't let you build any more towers, right? But there's even a bigger barrier than the towers. The what? Interest rates?
User base.
Oh, user base. Yeah, you have a very loyal user base, and we're locked in by contracts. So there's penalties to switch, even if an upstart comes in. But as I said, there's even a bigger barrier. The license. The licenses of the spectrum. Is the governments control the airwaves, and they limit who can have access to those airwaves. And they've done spectrum licenses, auctions, and whoever owns those rights through the auctions can use the airwaves, but anybody else can't just come in and use those airwaves. So again, in a way, the government controls the industry itself and controls the competition. So I'm just saying there's huge barriers to entry. It's not like we can just say, hey, let's go start up our own cell phone company tomorrow, right? So that's the point. It allows the industry to be far more profitable when there's lots of barriers to entry, okay? Then rivalry, fifth force. Is there a lot of rivalry amongst the players in the industry? Is it a monopoly where there's no rivalry? Are there just a couple of companies and they kind of cooperate with each other, right? Or is there just intense all-out rivalry for customers? Where are we along the continuum? So that's the idea of the 5 forces. And generally, the 5 forces explain about half of an industry's profitability, right? So go back to that chart for 50 years worth of, or 40 years worth of data. Pharmaceuticals were the top performing industry of the last 40 years or so. Why?
The barriers themselves.
The barriers to entry are very high to get into pharma. What would be an example of one of the barriers?
Like the biochemistry technology.
So just having the access to the technology is a huge barrier to entry. But there's another part of that too. What else? Yeah.
FDA approval.
Yeah, you have to have government approval. Anybody can't just, create a drug. I mean, you can't just create the chemistry's not that hard. And then assuming you have all the chemistry, you got to get the FDA approval, right? But there's another issue that they all run into, which is good for the pharmas, which is all these molecules are patented. A patent is a virtual monopoly. So that's the point. All the pharmaceuticals patent these drugs, which means in the US, for 17 and a half years, nobody else can sell that drug. Right? So, and even when you do, when the patent expires, they can extend the patent by changing the formulation ever so slightly. Right? And so then they can extend the patents. And so again, there's lots of barriers to entry, and that's one of the reasons why this industry has been historically very profitable. Now, let's think about the future. Is that the case going forward?
Yes.
Are the barriers to entry going forward going to be as high as they were historically? So I'm going to say that they're not. Here's one of the data points. 80% of all drugs in the US today are generic. Is that governments are now encouraging generic drugs. They're making it harder to keep those patents. They're making it easier for other companies to come in and offer generics, biosimilars. Why might the government be trying to do that? Because the prices of the drugs are too high and healthcare costs have gotten out of control. So in a way, the government said, we've created a situation where we're now paying a lot of money for these drugs, and we've let these industries make a lot of money, and now what they're doing is they're actually starting to change the rules slightly. Right? Now, it's not going to be a stampede. It's not like anybody can just go in there and start selling drugs, but basically, they are making it easier for generic companies to come into the marketplace. Regulated, but nonetheless, so I said, in the US today, 80% of all drugs are generic. And so it's really hurting the pharmaceutical industry performance. Now again, they're still making great returns. They're just not going to make as great a return as they have historically. The other thing that's changing is the nature of how the buyer power in this industry worked. Historically, for pharmaceuticals, a pharmaceutical company would have a sales rep call on a doctor. They'd educate the doctor about the drug, and the doctor would choose to prescribe the drug to the patient to help the patient solve their problem. How has that changed? Anybody familiar with the healthcare market today?
Yeah, you have to contact your insurance company. The insurance company decides what drug you take.
Increasingly, the insurance companies are playing a role by having what they call a formulary, which basically says in the US, a formulary is a list of approved drugs. And if the drug isn't on that list, then the insurance isn't going to cover it. So increasingly, the insurance companies are putting fewer drugs on their list of approved drugs, and it's making it harder to use some of the more expensive drugs. All right? Now, I'm not saying they won't make exceptions, but generally, they're trying to restrict the amount of drugs that you have choice. They're restricting the choice. Secondly, the drugs are actually being sold through what are called PBMs, prescription benefit management companies in the US. So those are companies like CVS, right? Or, I forgot the others, Medco was another one. And the idea is that these are, what we're doing is we're having 3 companies now represent something like 65% of all prescriptions. That they're the ones that are actually processing the prescriptions and doing the prescription drugs. So for example, at Maryland, I have my drug card, and if I get a prescription, then it's going to go through Express Scripts. Okay, so this is what's called the PBM company, and they're the ones that are going to do all the reimbursement, and they're the ones that are going to decide which drugs are on the formulary. But here's the point. It's no longer that Merck is calling on the doctors and getting the doctors to prescribe the drugs. Merck is now calling on Express Scripts and trying to convince Express Scripts that this should be an approved drug that doctors could prescribe and be reimbursed. And so what's happening is the choice of the doctors is going away. As a matter of fact, in hospitals, we are now doing in the United States something called the electronic health record. And the government has been pushing that all of us, if you're in the US, get an electronic health record where everything about you is going to be stored in a database. And what's happening is there's a couple of software packages out there. They're horrible, but nonetheless, they're the only ones out there, and all the hospitals are using them. And one of the advantages of the hospitals of these drug packages to do your e-health records is standardization. So basically what happens is if you go in to visit a doctor at a hospital, usually what happens is the doctor talks to the nurse, and the nurse transcribes everything, and then the nurse later will enter the data into the system, historically, on your chart. Well, now what happens is the doctor actually at the computer types in to the eHealth record directly the doctor's notes. So it actually saves time because you don't have to go through the nurse, and it actually reduces error rates. But here's the thing. Let's say the doctor wants to prescribe you a drug. It gives a pull-down menu of the drug to prescribe. Increasingly, that pull-down is being pre-filled. So instead of giving the doctor the choice, the hospital has basically said, if you have this condition, you should give out this drug. And it's the drug, by the way, that's been negotiated with the PBMs to give the hospital the best price. So, because they're going to do the most volume for that type of condition. It's called a DRG. So, long story short, you're seeing changes that are making it much more difficult for the pharmaceutical industry to make money. Not saying that they're going to lose money, they're just probably not going to make the same great rate of returns they have over the last 40 years. Right? So, interestingly, their monopolies are being cracked. Why are electric utilities the worst performing industry, or second worst performing industry over the last 40 or so years, if they're also monopolies? Because it's not like you have a choice of your power. Like, the power company is going to be the power company. And you're not going to live off of a generator for your whole life. So why don't the electric utilities make a lot of money?
Regulations.
That's right. It was the other side of the government regulations. The government regulations limit the prices they can charge because they want to make sure that consumers, the customers, get reasonable rates. So they don't let them exercise their monopoly power. So what actually happens in the U.S. is that there's what's called rate commissions, and what the utility has to do is go to court, and they argue in court about the rate of return. It's called rate of return regulation. And a judge, an administrative judge, basically decides what cost of capital they're going to allow these utilities to have. And they argue about it. And then the judge decides what's fair, and then basically it's cost plus. They basically figure out what their costs are, they mark it up by the cost of capital, and they back into the rates. And they're allowed to earn a certain return on their investment within about a 2% rate band, given some fluctuation in cost. But the point is, if you go beyond the band and your return gets too high, you have to rebate the excess profits back to your customer in the form of lower rates in the future. If your costs are much higher than expected, your return isn't high, then you're able to do rate increases in the future to make it up. So it's kind of a weird process, but that's essentially the process that utility rates are set now here in the US. But that's the point. These rate commissions, these administrative judges, keep the rates really low and keep the cost of capital relatively low. But here's the reason why they're able to do that. They guarantee the investors a rate of return. So the trade-off is it's almost like a bond. Utility stocks actually trade more like bonds because it's very predictable earnings, and the earnings are relatively safe because the utilities can recoup most of their costs if the costs are higher than expected with future rate increases. Right? Now, this isn't always the case. Sometimes for political reasons they can't, but the majority of the time they can, and that's why utility stocks have traded differently. But that's the idea. I need to understand there are different rules for different industries, and those rules explain the profitability, and changes in these rules will explain changes in profitability over time. So, here's the point. Let's say we're doing Best Buy. In Bloomberg, there's a screen called RV, and we had talked about this last week, but in the custom part of our template, we can very quickly create an industry ROIC. So here are the Bloomberg peers for Best Buy, not many. Here are the GICS peers. The problem is Best Buy is running out of peers. Stick with the Bloomberg peers for now. And what I'm going to do, it's not perfect, but I'm going to add target. Oh, wrong way. Edit the comparables. And I'm going to add Target, and I'm going to add Walmart as peers of Best Buy. All right. Now, Target and Walmart sell a lot more than consumer electronics, but nonetheless, that's probably a viable choice that people would go to in terms of stores and something investors would probably look at. So here are some peers. So we got a Sears store, we got GameStop, Conn's, Target, Walmart, Best Buy. I'm sure we can make the list a little bit longer. So I'll confirm this as my custom list. And I'll quickly add the ROIC for the latest year. And I'll add the WACC. Should type in the middle of the screen. WACC. All right. All sorts of problems today. WACC. Hit enter. Select stats. Market cap weighted average. So it weights it based on size. And what we can see is we quickly have an industry ROIC based on latest filings. Now, you can see that Best Buy lost money. They have a negative ROIC, so they're not doing so well. But let's start out with the industry. Is this an attractive industry? Why is it an attractive industry? Because the ROIC is greater than the cost of capital. Right? All right, so here's what we're going to do. In this class, we're going to use an arbitrary 5-point scale for each of the forces. And the 5-point scale is going to have meaning to us. It's going to be a scale of 1 to 5. On our arbitrary scale, we're going to do this in Excel. I'm going to pop open Excel. So I have my buyer power. I have my supplier power. I have my substitutes. I have my entry barriers. And I have my rivalry. And that will give me an overall performance of the business today. Right? So using a 5-point scale, 3 equals 0 spread, 1 equals negative spread, 5 equals positive spread. What I want to do is I want to score the industry. Okay? So, using a 5-point scale where 3 is 0 spread, 5 is a great spread. And what is a great spread? Well, historically, a great spread has been 24-25% ROIC against average cost of capital is probably around 9 or 10. So you're looking at a 15-point spread. That would be great. That'd be a 5. All right. What's a terrible spread? Well, average company earns around 9. Earning 2 or 3, negative 7 points or greater would probably be a 1. Right? So again, trying to scale the spread. If I exactly earn my cost of capital, that's a 3. So, give me a score here. For Best Buy, what's my score? If I scored a 1, I'm doing the industry now. That means the industry is a terrible industry. So I'm doing when I say Best Buy, I'm actually saying Best Buy's industry. So what would I score Best Buy's industry? Probably like a 4. All right. If I scored it a 3, that would mean that the ROIC should be around 6.7%. Since the ROIC is almost double the industry WACC, right? It's actually attractive industry, right? So I'm going to call that a 4. Now, I can be more granular, like if I want to say 4.2, 3.9, whatever, you can, you're a master's student, you can get as technical as you want. All right, but in this case, I'm going to say overall somewhere around a 4. Now, here's the next and important part of the exercise. And this actually threw the MBA students last semester. So basically, one of my students in the MBA class said, well, I don't believe the number. He's like, I just don't think that whatever industry we're looking at is that profitable. I just don't believe it. And I said, it's based on observable data. Like these companies actually reported these numbers. This is what they're actually making today. So that was the point. I think we were looking at the airline industry. And the airline industry right now is doing really well. And historically, it was doing really poorly. And he didn't want to believe that the airline industry was doing well because his bias was working against him, right? Because he knew that the airline industry historically did poorly. But right now, they're actually doing really well. So that's the point. When we do this analysis, we do it based on observable data, all right? We don't base it on gut feel, right? So that's the point. This industry is actually relatively attractive, right? So why? Using these other forces, we want to explain that. So score the other 5 forces so that the average is a 4, right? And by the way, it could be a weighted average, meaning some forces are more important than others. And for every force, let's take buyer power. If we score buyer power high, that means the buyers actually have no power, because what we're going to do is we're going to score it based on spread. So how does that force allow the industry to make a good or bad spread? If the industry makes a good spread because of that force, score at a high number. In this case, the buyer power would be low if the score is high, because we're scoring it based on the expected ROIC or spread of the industry. Does that make sense? So, buyers. Who has power in this relationship? Companies like Best Buy and Sears and Target, or us? So what's the score that explains this industry making money?
The lower percent.
1. If you score this at 1, you're basically saying this industry is doing horribly, which means something else has got to cause it to be doing really well, because this industry is making 12% on a 6% cost of capital. So if the buyers have all the power out there, and we just go wherever we want easily with low switching costs and lots of choice, why is this industry making money?
I would say it's higher than
You'd say what?
that. I would say it's higher than a 1. Because, I mean, you don't have that many retail stores to go to buy electronics.
That's right. There's very few retailers, so that restricts our choice. And so therefore that number is probably going to be a little bit higher. So give me a number.
I would say probably 3 or 4.
Let's round that off to 3.5. You said 3 to 4. I'll call that 3.5. So the buyers have some power, but it's not complete power because there's a limited amount of places that we're going to go for consumer electronics. All right? Suppliers. Think of Sony and Samsung, and they increasingly sell like washing machines at Best Buy, so appliance makers.
4.
If you say 4, you're saying the suppliers don't have a lot of power.
No,
They don't. Because increasingly consumer electronics is becoming commoditized. And there are fewer places that people go to buy these. So in a way, the suppliers are at the mercy of their distributors. Because in a way, the Best Buy is like the distributor. So if you want to reach $60 billion worth of customers, you got to go through Best Buy. So Best Buy is pretty big, and they're getting some scale effects. So like Walmart, they're probably leveraging it to get relatively low prices. Same thing. You go to Walmart, Walmart's going to leverage you as a supplier to get as good a deal possible. So that probably helps the industry. Substitutes. Are there substitutes for consumer electronics?
Yeah, they now can buy online.
Buying online. Is that the major form of purchase today? No. So are the substitutes hurting them? Are they hurting them to the point that this industry is not making money today? Might call that a 3 or 4. Back to the 3.5. But here's what we're about to do. In 5 years, do you think substitutes are going to be more of a threat to these retailers in 5 years? Will we basically shop Amazon or shop other online services rather than going to these stores and have it shipped to our home? Probably more and more. All right. So that's the thing, is we have to think about today and what's going to happen in 5 years. We'll come back to the 5 years. Is it easy to open up a nationwide chain? That probably is in their favor. Just because building the branded infrastructure to have a nationwide chain that people will go to is very expensive. And in today's world, no one's going to give you a loan to go do that. Because there are too many entrenched large competitors out there that kind of keep out the small players. I think that tends to help them. It's hard to get that national chain going. And how much rivalry is there? Price is all that different between a Walmart, a Target, and a Best Buy? I mean, slight differences, but it's not cutthroat competition because they're all trying to make money. So I would say that might be like a 4. Now again, your point of view may vary, and that's okay, but that's what you have to do, is you have to establish a point of view that explains the profitability of the industry. And then here's what matters next. What's this going to look like in 5 years? Because what we're doing is we're predicting what we think is going to happen to the ROIC of the industry in 5 years. So when we think about value in companies, if the industry gets worse, then obviously that's going to impact our view of the valuation. So how might some of these numbers stay the same or change over the next 5 years? Who has a point of view of this?
About 3.
Which one?
About 3.
But when you, I don't want you to do the overall, I want you to do each of the forces first.
Yeah, buyers.
So buyers a 3. So you think that the buyers will have a little bit more power over time, even more power?
I would probably disagree. If you look at like someone like Apple, an innovator in retail electronics, they're starting to dominate with their stores, and they're totally changing what retail means.
Yep.
And so they're gonna have a lot more power, probably like almost close to 4.5.
So I guess it really depends on certain parts of the industry could have some power, but other parts of the industry may lose power. So what you're actually arguing is somebody like a Best Buy is going to be hurt because Apple will continue to funnel people to their own stores.
It definitely depends on Best Buy's strategy.
So that's what I'm saying. If we think about this industry of the mass market retailers, not the specialty retailers, what would be the impact of the mass market retailers?
Like I said, we going down.
So maybe back to the 3. But that's another point. If we define a segment of specialty retail, that might actually get more attractive because people want that specialization. Okay, that's one argument. All right. What about substitutes? I think the online, as we talked about, is going to get even stronger. I think it's going to hurt the profitability of the industry. I think people are going to go to Amazon before they go to Best Buy. As a matter of fact, I do that now.
Yeah.
It's called showrooming. Is anybody here guilty of showrooming? You say, what is that? So what you do is you open up your Amazon app on your phone, and it has a scan the barcode. You're in Best Buy, you scan the barcode, it shows you the price on Amazon with the one-click buy. So you can check the product out at your local store, and then you buy it online. I mean, if it's cheaper, you buy it right there, but it's hardly ever cheaper. By the way, Costco will kick you out of the store if they see you doing this. So be careful with the showrooming. Recently, Best Buy embraced it. They, about 3 months ago, said we're going to allow showrooming because they realized they really couldn't stop it. But it really allows you to price compare. And that's what increasingly people are doing. And that thanks to technology, you can do it in almost real time because you're bringing your phone or your tablet with you. Just like I said, point at the barcode, and it will even tell you exactly the same merchandise item, what it is available online. Google's getting into this too. So I think the substitutes are going to become much more prevalent. That's going to hurt the profitability of this part of the industry. And the other thing is Amazon is spending a lot of money for same-day delivery. So it's not even wait 2 days to get it. It's actually order in the morning, get it in the afternoon. And in the BWI area, they're building a giant warehouse in Baltimore to enable just that. Is they are trying to get same-day delivery. Matter of fact, there's an interesting article about Amazon I read about a week ago that says Amazon is actually going to do anticipatory delivery. That they have enough data on you, your purchasing habits and your buying stuff, that they will actually ship you merchandise before you order it. Because they know you're going to buy it. And somebody asked them, they said, aren't you worried about returns? And they're like, yeah, we might get a few back. And they said, we might actually just let some people keep some of it gratis just to get it started. So if one day you wake up and like a DVD shows up on your door, it could be part of this anticipatory buying that they're now experimenting with. But they're really good with data, and they're really good at predicting demand. Anyways, so entry barriers, I think as a result of this, are starting to come down. Because the entry is no longer physical store. The entry is now essentially physical storefront presence. I mean, just as an example of this, my sister went to school to be an esthetician. She's a lot younger than I am, and she opened up her own spa. And she has a spa in Denver now. And the beauty products that she sells through her spa, she is now going to start selling on Amazon as a reseller. And so that's the point, is that she can, as a small business, overnight become a national distributor of the beauty products that she's buying from the salon in Denver, or through her salon, of the supplier through Denver. And the cost of doing it is the cost of enabling a shopping cart on Amazon. You have to give them a fee for fulfillment, but basically they'll do it for you. And so you can set it up yourself. And I'm saying that should scare the hell out of Best Buy, because it's not just Amazon, it's Amazon and their resellers. And there was a data point I read, Amazon doesn't break it out, but there was an estimate that 40% of Amazon's business is coming through resellers. And that's what they're doing, is they're basically like the mall, and they're saying, come to our mall and we'll do all the fulfillment for you. We'll put you into our database so it's easy to search and market, and then you just supply us the products. So again, it's really, I think, going to hurt the companies like Best Buy going forward. And I think that that's going to increase the rivalry. I think suppliers are still not going to have much power, but overall, I might call this a 3. So I guess what I'm saying is, what we're doing is we're using the 5 forces to predict that this industry is probably seeing an ROIC in the mid-single digits in 5 years, if this prediction were to come true, right? So that's what you're going to have to practice this semester, is establishing a point of view on what's going to happen to the ROIC of the industry. Observe it today. All right, there's actually a correct answer to this one. What is it today? Explain it, forecast it, and then tell me what it's going to be in the future. By the way, one other source of data is through Smith Apps. So on our portal, if you haven't used it, smithapps.rhsmith.umd.edu is the portal, the Smith portal. And in the portal, there's a finance folder. And in the finance folder is a product called Ibis World. Now, it's running it through a product called Citrix. So you're not actually running the software on your machine, you're actually running it through a central server here at Smith, so we can all share it. But what Ibis World does is they write industry research reports. So for example, I can type in any company, Best Buy, do a search. It'll tell me what industries they're in, that they're in research reports. Consumer electronics stores in the US. I click on this, and then I can also download it as a PDF, but this should give me an industry report on the consumer electronics industry. And this was done in September 2013, so it's relatively recent. But that's the idea, is that this class is called applied equity analysis, which means real world. It's perfectly acceptable to use real world data sources on the analysis that we're doing. So this is a real world data source that we could use that's available on the portal. And so again, if I don't know anything about an industry and I gotta analyze it, I can go look up the industry. And so one of the nice features here is over here on the right-hand side is the industry outlook. That's basically, they've done a 5 forces analysis already, right? And as a matter of fact, if I come over here to key statistics, they also have forecasted growth rates for the industry already done. So again, as we think about the future, we can use some of these data sources to help us understand what the future of the industry is. So they are predicting a little bit of growth in this industry over time, which is mass market retailers in the US. So again, slightly different than our more pessimistic view, but again, it's not saying they're right, but if you know anything you know about retail, you can at least read what they have to say and what their rationale is as you're doing these analyses. So again, that's a product called IBIS World. It's available on the Smith Apps portal, right? And if you've never used the Smith Apps portal before, one other thing that you would have to do is when you first get there, it does use something called Citrix. So if you go over here to content, the very first time you log in, you only have to do this once on the computer you're on, but go to the Citrix client and then download the Citrix client. Okay, so the Citrix client is what essentially allows you to run the portal software. So if you haven't run it before, you need to load Citrix onto your machine. All right, I already had it loaded. You saw it kind of pop up when I opened the app, but it's a one-time download per machine. Okay, final step, and you're doing this on your homework assignment, is competitive advantage. Does Best Buy have competitive advantage? No, because we're defining competitive advantage as ROIC of the company against ROIC of the industry. Ideally, spread of the company against spread of the industry. All right, but since most cost of capitals are pretty similar, usually ROIC is the differentiator. With Best Buy, it doesn't matter. They're so bad in their performance compared to any metric, you know that they lack competitive advantage right now. All right, that's EIC. And again, this is 1/4 of your group project. What we're really doing with EIC is we're trying to understand primarily the last 2 questions, because we're going to start forecasting financial performance for companies. So we need to understand, what should our forward forecast be influenced by at the industry level? What should our forecast be influenced by on whether the company has competitive advantage? So we forecast out the industry. Should the company doing better or worse than the industry, and why? Okay, that's what we're really trying to do with the EIC. All right, lecture note 2. So our other topic for this week this way, is I want to talk to you about the process for valuation. And as part of the process, on Wednesday, we're going to talk about how to convert the accounting statements into an economic format. But our overall process for valuation that we're going to follow this semester on a cash flow basis is kind of highlighted on this slide. That first, we're going to analyze historical performance. So in order to predict the future, we have to understand the past. Second, we're going to forecast the financial statements to get us the forecasted cash flows. So as part of the analyzing historical performance, before we're able to forecast, we're also going to convert the accounting statements into an economic format. We'll then forecast the economic statements, which will get us the forecasted cash flows. At some point, we're going to realize it's too difficult to forecast for long periods of time. Because when we forecast a company, there's an assumption that companies last forever. So we have to value companies as if they have cash flows that last forever. Well, what is Google's revenue going to be Google's revenue be in the year 2050? Nobody knows. Like, I actually worked for Google, and I asked them that, and they laughed. I'm like, we don't know. And that's the point. Nobody knows. So we have to figure that out, though, if we're going to value Google. So that's where we use what's called a continuing value. So we forecast a number of years until it doesn't make sense to forecast anymore because our forecasts are getting less and less meaningful. And then we use a continuing value to proxy the long-term value of the company. We then have to discount all these cash flows at a cost of capital. So talk about doing that. And that's going to get us enterprise value. And then what we're going to have to do is we're going to have to take the enterprise value and get to an equity value by subtracting off the non-common equity claims divided by shares equals share price. And then finally, we're going to have to go through an iterative process to test our assumptions and make sure we really understand what's happening with the valuation. So that's really the process that we're going to be following over about the next 3 or 4 weeks of class. And as I said, this week is really about number 1, analyzing historical performance. Next week will be about forecasting. Okay? That's really what we're going to be focused on for the next 2 weeks before the midterm. All right. So when we talk about valuation, there are many different models for valuation. And here's what's important for you to remember. The value of the company should not change if you use a different model to value it. Like, the value is the value. And just because I'm taking a different approach shouldn't mean I get a different answer. I should still come up with the value of the company, right? And that's part of one of the things I'm going to prove to you in this class, is that we're going to take 2 different approaches to valuation. We're going to do a cash flow approach called Enterprise Discounted Cash Flow, or EDCF, which is very similar to NPV. We're going to value companies on an NPV basis. And then we're going to do what's called an economic profit, or EVA-based method of valuation, economic value added. And we're going to show you, and you're going to show me, that you're going to get the same answer with both approaches. Matter of fact, that's your final exam. So if you can do that on your final exam, you'll do well in this class. If you can't, well, not so well. Right? So that's going to be the key, is to show you get the exact same answer with multiple approaches. And so what's really different is, what I like to think of as, it's really just rearranged equations. That's all these different approaches are. They're just rearranging the equations. So when I say that, Enterprise DCF is primarily a free cash flow driven model discounted at a cost of capital. And it is, again, very similar to NPV. The advantage to the Enterprise DCF model, which is the most popular model used in the real world. I'd say I've seen 90% of all valuations out there plus that I've ever dealt with are enterprise discounted cash flow valuations, assuming you're doing a cash flow valuation. So in the real world, this is what people use. And the reason why they like this model is because, since it is based on NPV, it's very flexible, and it also can be very additive, right? So for example, I have 3 business units. I can value the business units independently. I can add the 3 together to get an overall value of the company, right? So again, it's a very flexible model. I can value projects. Companies are some of its projects. I value all the projects. I add it up. I get the value of the company, right? So again, it's based on NPV. Second model, the discounted economic profit, is what's known as a spread model. The idea of spread model says that I want to look at how much value is created or destroyed during a period of time. I then forecast how much value is created or destroyed every period of time in the future. I add it up. That's the overall change in value to the company. If I add the change in value to the company to the initial investment that I make, I get the valuation of the company, right? So basically, the spread model, or the discounted economic profit model, gets me the same answer. It just does it with a slightly different point of view. 3 other models I'll briefly mention that you're not responsible for this semester. One is what's called APV.
APV stands for adjusted present value. This is the model that you would use to evaluate a substantial change in the capital structure of a firm. So one of the implicit assumptions of the NPV model and the discounted economic profit model is that a company will have a constant target capital structure. Certain amount of debt and equity that will stay relatively constant over time. The APV model, adjusted present value model, was created to value changes in capital structure. So let's say I'm Dell and I wanted to go private, and I got a bunch of private equity firms to help me go private last year. They would have looked at an APV model because they would have said, Dell's a publicly traded company, we're going to take them private. What would they look like with a bunch of debt and almost no publicly traded equity? So they're going from a lot of equity and a little debt to a lot of debt and a little equity. That's when you use APV, right? Or let's say you're doing an IPO. I go from all equity to adding some debt after an IPO, all right? Or just however I substantially change my capital structure. The fourth model is what's known as the capital cash flow model. This model I find to be the most useless of the 5 that are mentioned in the book. I've never seen it used outside of an academic setting, and so therefore I don't really want to spend a lot of time on it. But part of what you're going to struggle with on Wednesday is we're going to spend a lot of time taking the cash flows of the company and breaking them out into 3 pieces: operating cash flow, non-operating cash flow, debt cash flow. And we will find a lot of value in evaluating the firm of its operating cash flows separated from the debt cash flows. So for example, we have 2 companies. One company has a lot of debt, the other company has no debt. By definition, the company with no debt, if they're the same operating cash flows, will be more profitable than the one with debt. It doesn't mean they're a better company, because the operations are worth the same. They have the same operating cash flows. The only difference is one company chose to fund itself with debt and the other didn't. So if I think about it, what I care about is how valuable is the company, and then I can evaluate the financing separately, right? That's what we do in the real world. That's what matters to investors. Is I want to look at a company, regardless of how it's financed, to figure out how valuable is it running its assets, and then figure out the cash flows to the finance holders. What capital cash flow does is capital cash flow says that if you disaggregate the parts and add them together, you get the same answer as if you left them as a whole. So capital cash flows don't break the cash flows into pieces. They just look at the lump all cash flows together, forecast them and value the company, and you get the same answer as if you break them into pieces, right? So intellectually, great, I agree with you. Somebody got a great dissertation defense based on that. But in the real world, nobody actually uses that because there's so much more value in disaggregating the cash flows, breaking them up into pieces to understand the difference between the operating and the financing flows. So you just don't see the capital cash flow model used in the real world because it doesn't really tell you anything other than the overall value of the company. There's no real meaningful analysis that come out of the capital cash flow model. The 5th model is called the equity cash flow model. That's what's used to value financial institutions. So I do a lot of work with banks, and the problem with banks is figuring out which cash flows for banks are operating and which cash flows for banks are debt is very difficult. Because for a bank, they get interest income on loans. They have interest expense associated with funding the loans. That's operating. They get what's called a net interest margin between the two. Banks also have debt that finances their long-term capital. So for a bank, debt is different than for a manufacturing company. For a manufacturing company, if you have debt, it's financing. For a bank, it could be financing or it could be operating. It could be your cost of goods sold. So it's difficult to distinguish for a bank which debt goes into which category. So what we do is we don't. We just figure out all of the cash flows to the equity holders, net income, and then we value that equity cash flow, right? And we get a value of the equity. As opposed to with a manufacturing or service firm, it's often called an industrial firm, what we do is we value the operating cash flows, and then we subtract out the debt and the equity. Subtract out the debt to get the equity value, divide equity by shares. So the primary difference between the two is with the equity cash flow method, we take enterprise value minus debt equals equity and just value the equity. With the enterprise DCF model, we value the enterprise value and then we subtract out the debt to get the equity value and then divide by shares. So it's just sort of the nuance of how you do the model, but that's primarily the difference between the two. So because financial institutions are hard to value, we're not going to cover them this semester. All right, so back to enterprise DCF. And the other reason is we just don't have time, not in the way that the class is structured. So we only have time to cover the first two models. If it were the whole rest of the semester, we could probably do banks as well. All right, so free cash flow. That's the key driver of operating value of a business. So assuming that the business doesn't have any non-operating values, we forecast the free cash flows, we add them up, we get an enterprise value of the firm. We can also forecast a debt and an equity cash flow holder value, forecast those, debt value, equity value has to equal the enterprise value of the firm because that enterprise value belongs to the debt and the equity holders of the firm. Another way to think about this, I mentioned the idea of a company with 3 business units. We value the 3 business units independently. Because enterprise DCF is based on free cash flow, we can sum them together to get the overall value of the firm. Most companies have a corporate center which doesn't generate any cash profit. It's just a cost of doing business. Subtract out the value of the corporate center, which is legal, HR, senior leadership, shared services. You get a value of the operations of the firm. Add in any non-operating value, you get enterprise value. Subtract the debt, you get an equity value divided by shares, share price. That's the method. It's a very straightforward method that we're actually going to go through. So what's key to enterprise DCF is it's really based on free cash flow. That's what drives the operating value of the firm. And again, what we're going to do is we're going to forecast the free cash flows for a period of time until we can't forecast it anymore, in which case we'll then call it the continuing value of the firm. Now, this was a final exam question that about 60% of my undergrads missed last semester, so I'll just throw it out here. But what is the appropriate amount of time to value a company before you go into continuing value? How long do you stay explicit before you get continuing value and proxy the long term?
Depends on the industry.
That's right. The key word is it depends. Because it was a multiple choice question. It was 5 years, 10 years, 15 years, 20 years, none of the above. And the answer was none of the above. And the answer is because it depends. It depends on not just the industry, it also depends on the stage of the firm, right? And what's key here is that ideally, when you go into continuing value, because there's 3 numbers that drive continuing value, cash flow, discount rate, and growth primarily, you want the company to be mature. You want the cash flows to be relatively stable and relatively predictable. So basically, the answer is I need to forecast enough years until the company is mature, and at that point, I can put the company into continuing value. So for example, I can go to Pandora today, and I can use the key value driver equation, continuing value equation, to value Pandora long term. Does that make sense? What would be the challenge with that? Yeah.
Too new of an industry, you don't really know.
That's right. You don't even know what a reasonable return on investment is going forward if you think about key value drivers. You don't even know what a reasonable amount of cash flow is because they probably are cash flow negative right now as they're in heavy investment stage. So figuring out what is reasonable for a continuing value assumption for an internet startup like Pandora is extremely difficult, right? But let's say I'm doing I don't know, CSX the railroad. Matter of fact, they're a Smith client. I'll be teaching them, I think, in March or April. But here's the point. Like, railroads grow about 2 or 3% a year. They have a very predictable business. I mean, they're pretty boring. I mean, not that they think they're boring, but, you know, there's not much to their business. I could probably go 3 years of predicting their earnings and go continuing value, and my valuation model would probably be just fine, right? So again, it really just depends on the nature of the business, but what I really want is I want the company to be mature when I go to continuing value. Do I always do that? Not necessarily, but in an ideal world, that's what I should do. So if I were doing Google, I wouldn't do 5 years of Google and then continuing value. I'd probably need to do 10 or 15 more years of Google before I thought Google was truly mature. And then I would put a continuing value into Google, right? Because the idea is that continuing value is a big chunk of the company's value. And when they're in growth mode, there's still a lot of uncertainty. So putting a company into continuing value with a lot of uncertainty just means that those 3 or 4 continuing value assumptions that you're making just give you a wide standard deviation of error. Whereas if the predictability of the company is much more narrow, you get much less standard deviation of error if the company's mature when you go into continuing value. That's why we want the company to be more mature. All right. So when the company is mature, that's why we're going to use the key value driver equation for the continuing value. We also have to estimate a WACC. Talk about the semester. And this is a key slide. The slide looks incredibly boring, but this is one of the critical slides of the semester. So in the reading for the book this week, McKinsey, and by the way, the guy that's one of the editors of the book, his name is Dave Wessels, is a really good friend of mine. I actually met him when he was working for McKinsey in their New York office, and I was teaching at Emory University, and I was brought into McKinsey's analyst training program. And so I used to train their analysts. So basically, if you get hired by McKinsey, either as a undergrad and you don't do a business major, then they put you through about a 4-week boot camp where you get an MBA in 4 weeks. And they just, teach you a bunch of stuff before they turn you loose on the clients. Matter of fact, they have another program called Mini MBA, where they take people with masters and PhDs in non-business degree, so you get a PhD in chemistry, or you got a master's in computer science. They'll run you through the Mini MBA program, and same thing. They put you through about a 4-week boot camp on business before they turn you loose on clients. So in the ATP program, I met David Wessels because we both were teaching the financial component to the analysts. So long story short, the reason I mention this is that Dave was working on Home Depot for McKinsey, and now he's a Wharton professor. He's left McKinsey, he teaches at Wharton, and he's now one of the authors on the book that we're reading. And he had just finished the valuation of Home Depot, and they used that as the example. And so this is 2008, when the book was written, this edition. They're actually working on the next edition now. But the idea is they said, and Home Depot said okay for publicly available use, that this was a simplified version of McKinsey's valuation of Home Depot using the enterprise DCF method. Okay, so this is actually how they do it. So the idea is that they had to forecast the value of Home Depot. So what Dave did is he predicted year by year the free cash flows for Home Depot. And remember, the time frame the book was written was 2008. So they predicted 2009, 2010, 2011, etc. The free cash flows, which is basically the cash flows that Home Depot would earn by people coming to their stores and buying stuff, right? So they forecasted revenue, they forecasted expenses, forecasted taxes, whatever's left was and they forecasted reinvestment in working capital in stores. That was the free cash flow. They estimated a cost of capital. They discounted those free cash flows to present value at that cost of capital. So the discounted free cash flows. Starting in the year 2019, which was year 10, Wessels said, you know what, it's too difficult to keep forecasting the cash flows, so I'm going to use the key value driver equation to do continuing value. So they used the key value driver equation, they calculated continuing value. Now, the key value driver equation is a growing perpetuity, so it actually discounts the cash flows to a present value, right? But the present value would have been the beginning of 2019, which technically is the end of 2018. So January 1st, 2019 and December 31st, 2018 are virtually equivalent in finance. So what he had to do is he had to bring that perpetuity value back to today's value, December 31st, 2008. So he discounted it at the same discount rate as the end of 2018. Because 2019 was already discounted by the key value driver equation. Common mistake people make, but you don't want to double discount that year. Okay? So that's why they didn't rediscount that year in this valuation. But that's the point. I got my operating value for the first 9 years, operating value for year 10 into perpetuity. I sum them up just like an NPV, and I get the operating value of Home Depot, 62,694. So 62,694,000,000, assuming those cash flows come true. Now, here's something that we probably won't do this semester, but we could, and that is they use something called a mid-year adjustment factor. What they did is they took a half-year discount factor and they future valued the entire valuation by 6 months. And the reason why they did that is it's a limitation of cash flow. If you think about 2009, the 5448, which is discounted to a present value, assumes that all of this cash is earned at the end of the year. But realistically, Home Depot doesn't get all of its cash on December 31st. It's earning cash every day as people walk into their store and buy stuff. So what they did to flatten out the year is they just future value the valuation 6 months to basically say if the cash was earned in the middle of the year, then that would be the same as earning it equally every month for 12 months, right? And what they're saying is that adds about $2.5 billion to the valuation because we overly penalize companies when we just use the straight present value equation because companies are always assumed in the present value equation to get cash at the end of the year. Now, I'm telling you, in the real world, very few analysts actually do this, right? It's good practice, probably should, but very few actually do, right? But nonetheless, letting you know it's there and probably something we should do. Now, for shortcut purposes, we may not do it this semester, right? Just because we got a lot to cover, and sometimes we'll take a couple shortcuts, but this will be one of the shortcuts we'll probably take. But if you are really looking at this, you probably should think about adding a mid-year adjustment factor. Or if a company is more cyclical, a different part of the year adjustment factor. So for example, if I were doing a tax company like H&R Block, in the US, all of our individual income taxes are due in April, so H&R Block makes all of its money right now. Makes very little money after April, makes all its money between essentially January and April. So I might use a discount factor that's different than mid-year for them, but as I said, you get very technical here. So long story short, that's the value of operations. They then added in the non-operating assets, and that got an enterprise value. They then subtracted out the debt and what's called the debt equivalence. Home Depot leases a lot of stores, so the value of the leases. Enterprise value minus debt equals equity value divided by shares equals share price. Right? Now, here's why this is also important. It's debt and debt equivalence. So again, I'm going to go back to Google Finance. And I'm going to look up Starbucks. Assume everybody's familiar with Starbucks. SBUX. Stock price today is at $74 a share. Not too long ago, they were at $8 a share. But here's the point. One of the reasons they're at $74 a share is because they have a pretty strong balance sheet. This is their balance sheet according to Google from September 2013, annual balance sheet. Annual data. Switch it to annual data. So here's their fiscal year ended September 29th balance sheet. Again, they got about $3 billion worth of cash. And here's the key number here. They have long-term debt of about $1.3 billion, total debt of about $1.3 billion. So if we were valuing Starbucks, we would take their enterprise value, assuming we forecasted that, we'd subtract off the debt of $1.3 billion, and we would get the enterprise value, right? But here's the challenge that we run into in today's world. Is this really all of Starbucks' debt? And unfortunately, we can't tell anymore by just looking at the balance sheet. Because companies have gotten really good at hiding debt off their balance sheet. So we'd have to go look in the footnotes, the place nobody looks at. And by footnotes, what I'm talking about is stores. If you go to a Starbucks store, they don't own that store. They lease that store. And they lease it with what's called an operating lease. What does that mean to the balance sheet? How does an operating lease work with a balance sheet? Anybody know?
It causes expense every month.
It's expensed every month or every year whenever you pay the operating lease payment. And how much of the value of the operating lease shows up on the balance sheet as a liability? None. So, here's what I'm going to do. I'm going to go to the SEC.gov website, and I'm going to look at a database called the Edgar database under filings. So I can search for companies' filings. And in this case, I'm going to look up Starbucks. And I'm going to go to, make sure I got the right one. I'm going to go through their company filings, and I'm going to go to their 10K, which is their actually, I think I'm on the wrong Starbucks. Here we go. We go to their 10K. There it is. And I'm going to click on Documents. And here is the 10K. Pages and pages of boring text. If you have insomnia, start reading a 10K. Put you right to sleep. So here's what I'm going to do. I'm just going to do a search. And I'm going to search for lease, which is going to have some pleases in it too. Blah, blah. Okay. By the way, we own our roasting facilities and lease the majority of our warehousing and distribution locations. Starbucks had 10,194 stores, almost all of which were leased. We also lease space in various locations, yada, yada, yada. Important line buried on page 15 in the text. And the reason why that's important is we're getting to a table soon. Here we go. Operating lease obligations. $4,585.9 million. So these are non-cancelable operating leases. $4.5 billion. If you looked at the statements of Starbucks, they have no capital lease obligations. They just have long-term debt of $1.3 billion, but they have real debt closer to $6 billion because they hid $4.5 billion from unsuspecting investors. And Starbucks has, sorry, wrong company. Starbucks has shares outstanding of 750 million. So 750 million into 4.5 billion is, what's that, about $6 or $7 a share in debt that you would misprice Starbucks if you didn't understand that they had a bunch of operating leases. So that's the other thing that we have to look at. We have to look at all the debt and what we'll call debt by proxy. So, for example, last week you saw Excelis on my list. I was working with a company called Excelis, which is a defense and aerospace spinoff of ITT, and they have a very big pension liability of over $1 billion. It's in their footnotes. The analysts that follow them know about this, but if you just look at their balance sheet and you miss the pension liability, then you would misprice them because that pension's got to be funded. That's the deficit before the shareholders can be paid. Right? So again, we'd have to put that in to the overall valuation of the company. So unfunded pension liabilities and leasing obligations are things that we'll typically have to find in the footnotes when we value the company, to truly value the company. Because if we just look at the balance sheet, we won't get a true picture of what's really owed. because technically the shareholders get what's left after everybody else has been paid. So we got to make sure that we account for everybody else. And companies can hire Ernst & Young and PwC and all the other accounting firms to help them hide it. Okay? So that's just a challenge that we've run into in the world today. Goldman does it. They all hide it. Anyways, fast forwarding here. Model number 2, economic profit. I think the book does a good job of explaining economic profit. If you have any questions about it specifically, please ask on class on Wednesday. But that's the next step, which is looking at the economic profit model. Here's what's going to be different. This is model number 2. With Home Depot, we're going to forecast their balance sheet. So here's the forecast for Home Depot's invested capital for the same period of time that they forecasted the free cash flows. Okay? So instead of forecasting the free cash flow in the economic profit model, you forecast the invested capital. They also forecasted the ROIC, and they used the same cost of capital. Well, ROIC minus WACC is spread. Spread times invested capital equals economic profit. Okay? So it's the capital times the spread equals the economic profit. We discount the economic profit, which is the 1 period change in value, just like we discounted the free cash flows. We also calculated continuing value of the economic profit, just like we calculated continuing value of the free cash flows. We put that back into present value. We sum it. We get an overall value of economic profit, which is the change in value of the firm. So this is the change in value year by year for the first 9 years. This is the change in value into perpetuity. We sum up the changes in values. We get the overall change in value of the firm. We add it to the original investing capital that the firm started with. We get the overall operating value of the firm, 62,694. That number should sound slightly familiar because the 62,694 operating value, calculated using the economic profit method, exactly equals the 62,694 calculated using the DCF method. Everything else below is the same. But what's key is how we calculate the operating value. And that's what I'm saying. On your final exam, that's half your final exam right there. Is I'm going to give you financial statements. You're going to have to calculate the DCF and the EP value and arrive at the same answer. Okay? And like I said, pretty straightforward process, but an important one to understand. All right. By the way, last point, we'll call it a day. APV. You're not going to be responsible for doing this. But since you're master's students, I just want you to understand this. So McKinsey also did at the same time an APV model of Home Depot. Like I said, this is valuing the capital structure. So here's how it works. To do a capital structure valuation of a company, you do the same free cash flows that you do in the NPV, in the enterprise DCF. What you then do is you forecast the interest tax shields, right? Remember, the interest tax shield is the interest rate, the interest expense times the tax rate. It's the tax savings that you can deduct by deducting interest, okay? So interest expense times tax rate equals tax shield, interest tax shield. So this is the tax savings of interest. You present value using a cost of equity, a higher cost of equity, as opposed to the weighted average cost of capital. Specifically, what you actually want is an unlevered cost of equity, okay? So you basically discount with a higher cost of equity the cash flows and the interest tax shields to a present value. You sum them up, including the continuing value. So you continuing value the tax shields, you continuing value the free cash flows. When you add those two present values together, you get the operating value of the firm, 62,694. So you get the same value as the other two methods. But notice how you get different answers to questions. What is the value of having debt in Home Depot's capital structure? Said another way, if Home Depot didn't have any debt in its capital structure, what would its value be? 53,240? So that's the point. Why are they worth 62,694? Because of the tax subsidies the government is giving them on the capital structure. Everybody see that? So here's what you do in the real world with the APV model is you run simulations. So if I want to change the debt, I can figure out approximately what my interest cost would be with a new credit rating associated with having more debt. And that would tell me how much my firm would be worth with those additional tax shields. However, I'd also have to estimate the additional cost of equity associated with having more debt in my capital structure. And then I'd see how my net present value changes. So do the tax shields outweigh the additional cost of equity? Now, in the academic world, Modigliani Miller would say that those exactly offset each other. In the real world, the market isn't as efficient as that. And so companies try to exploit that. So what a company will do is they'll say, hey, I can get the bond market to give me the additional debt, and they're probably not going to charge me the extra cost of equity for that additional debt. And so they'll misprice me, and I'll exploit that. And they'll run a simulation to basically figure that out. So, for example, I was looking at Amgen, big biotech that did a big bond issue to pay out a dividend. And Amgen was going to have their credit rating reduced as a result of issuing the big bond issue. But what happened was they issued it about 2 years ago in the middle of the end of the financial crisis, and there was such a demand for high yield debt by the market at that time that they were actually able to place all their new debt at an interest rate far better than what their credit rating would suggest by Standard & Poor's. And so they then used that to pay off their debt, or sort of buy back their stock, and they actually got kind of a break in the marketplace because the yields on their debt were better than what the credit rating said it would be, even though they just issued a bunch of debt. So again, they exploited inefficiency in the market. And they probably ran the APV to say, you know what, it's probably worth doing it, because they could get good yield on their bonds and what the investment banks were able to get them, which was much better than what their credit rating was allowed it to be. So again, the point is, this model really only makes sense if you start changing the capital structure. Otherwise, it's a lot of work to just tell you the value of the tax shields, right? So again, model APV, what's the value of the tax shields? Spread model, how much value was added to the original assets invested? Concept known as MVA, market value added. At the time, how much value was Home Depot adding to their investment? The answer is on this page. That's the 25,619. So this is what the spread model tells you. Home Depot invested $37 billion of actual money, investor money, in their stores. They added $25.6 billion to that to get an overall value of the firm. If I do DCF, it just tells me the overall value of the firm. So the advantage of the spread model is it gives me an additional insight that the DCF doesn't. That says not just how much did I spend, but how much did I spend and how much value did I add. That's really what the EP model, economic profit, EVA model does that the DCF doesn't. So with all that in mind, here's what Wednesday is going to be about. Wednesday, your homework is due. So if you have any questions about your homework, please ask them either after class or send me an email. Homework 1, right? 2, we're going to do the economic statement conversions, right? So basically, I'd strongly recommend, because you're going to struggle with that, read the chapters in advance. It will really help you as we go through Wednesday's class, right? Other than that, we'll see everybody on Wednesday morning. Have a good day.